All, welcome to the second session on accounting principles. I am Priyanka and I'll be taking today's session. So, in the last session, we saw about the principles of accounting, the basic principles, like what do you mean by accounting, why do we need accounting, and the types of accounting, and some of the basic terms and basic accounting concepts. In this class, we will talk about the accounting process. Okay, so initially, we'll start off with the transactions. So, the system of recording transactions in the book of accounts are generally classified into two types. One is the double entry system, and two is the single entry system. So let me explain the single entry system first because it is quite easier. Just like the name suggests, there's something single and here something double or dual. Okay, so in single entry system, the money you will write down where the money, I mean, what money came from, like, for example, sales, and what money went out, like for expenses. Okay, it is quite easy to maintain. The drawback is that it doesn't give you the full picture, like where the money is going, what you own, the assets or the liabilities. That is not mentioned clearly in the system. Okay, say for example, you sell chocolates and you write it down, sold chocolates for 100 rupees, but you don't write where that 100 rupees went or whether it came from a customer who still owes you. You get the point, right? So single entry system is just a only one entry made per transaction, and it just denotes one side of the account book affected at that particular time. Okay, so when it comes to now let's talk about the double entry system. This is like a detailed account book. Okay, whereas single entry system, okay, compared to it. So here every transaction is recorded in two places. One account is debited, like what you get, and another account is credited, what you give. This is more accurate and it gives you the complete financial details. And it is also used in all big companies. Okay, for example, you sell chocolates for 100 rupees. Okay, so it is a cash sale. So increase in cash, the debit is 100. So decrease in the stock or inventory or the credit is 100. This way, everything is recorded. You record everything, right? Clearly, and you can see the profit, loss, assets, and debts. Okay, so this is like a twofold effect of each and every transaction. I hope you're clear with single and double entry. So in single entry, only one-sided entry is required to record the financial transactions. Whereas in double entry, every transaction affects two accounts simultaneously. So it is known as a double entry. Single is obviously simple, and double would be complex. And simple is quite incomplete. Double will be complete. Okay. So the errors in single entry system are quite hard to identify, but the errors in the double entry system are easy to locate. So these are the major differences between a single entry and double entry system. Okay, all right, you get it. In case if anything is not clear, please let me know in the comment section. I would try to help you out. Okay. So let's talk about the benefits of double entry system. Okay, just give me a moment. Okay, yes. What would be the benefits of double entry system? I've already mentioned you. So you get the complete record of every transaction, okay? And it helps you to find mistakes easily because both sides must always match, right? Something is missing or wrong, you can easily find errors. The third thing is you can find the true profit and true loss. By recording everything properly, it helps you calculate how much money you earned or how much you lost, right? And it also shows what you own and what you owe. So your assets and liabilities are clearly mentioned so that you can know the exact financial position. And it is trusted by everyone, trusted by banks, investors, tax officials, and others, because it is quite accurate and flexible. Okay, business that want to grow or take loans must always follow the system. And also it makes it easy to prepare reports. With the double entry system, it's easy to make balance sheets, profit and loss accounts, and trial balances. All these will help in making business decisions better. Okay, so all right. I hope you get a clear picture of what a double entry system and what a single entry system is, and what are the benefits of double entry system. Okay, so now let's move on to business transaction. So first, what is a business transaction? It involves two or more parties and are recorded in at least two accounts. Okay, so in general, business transactions are transactions of financial value that involve two or more parties and are recorded in at least two accounts. Okay, so what are the examples of business transaction or day-to-day life? Examples will include cash memo, invoice, pay slip, then checks, then you have your salary slip, etc. And also, in a previous class, we spoke about voucher. What is a voucher? It gives you the proof that a transaction has been made, like an evidence, right? So it is also called as a source document, right? So what are the different types of vouchers? Vouchers include cash vouchers, debit vouchers, credit vouchers, journal vouchers, etc. And also, what is A? What is A? A means assets. L, liabilities. C, capital. Okay, so liabilities are the claims of outsiders, while capital is the claim of the owners, right? Yes. So these are just the basics of what a business transaction is all about. And if you want to talk about the asset side, the asset side of the balance sheet is the list of assets, right, which the business owns. So the liability side of the balance sheet is the list of the owners owners claims and outsiders claims, right? That is what the business entity owes. So now let's move on to the approaches to accounting. What are the basic approaches to accounting? So the two basic approaches to accounting includes cash basis and accrual basis. So cash basis, as the name suggests, they record money only when it is actually received or paid. Actually received or paid. Okay, it's like writing in a diary, I got 500 rupees today, or I paid 200 rupees today. So it's quite easy to understand, and it is used by small businesses or individuals. To make it clear, you sell a cake today, but the customer says they'll pay you next week. In cash basis, you don't record it now, you record it only next week when the money actually comes, right? You get it? So now we'll talk about accrual basis. Accrual basis is you record money when the work is done, not when the cash is received. So this does not basically depend on the cash. This depends on the cash. Okay, so it's like I sold a cake today for 500, even if the money comes next week. So this gives you a more accurate picture of the business, and it is used by most of the companies. So yeah, you sell a cake today, customer will pay next week. In accrual basis, you record rupees 500 that you have received today itself because you earned it today. So that is a basic difference. So I will tell you the differences now. So in cash basis, the cash is received, so it's recorded when the cash is received. In accrual, when it is earned. Okay, and also when are the expenses recorded? When cash is paid here. But here, when the cash when it is incurred. Okay, so cash basis is quite simple, but accrual is quite detailed and more accurate. It is used by cash basis, it's used by small businesses, individuals, but accrual basis is used by companies, big companies, businesses, etc. Okay, So in general, cash basis is show only what's in your pocket right now. Accrual is show what you've earned or spent even if the money hasn't moved out. Right? You get it right now? I hope you understand. So now let's talk about some of the basic accounting concepts. Okay. What is GAAP, IFRS, INDAS? So GAAP, these are basic rules and guidelines that tell us how to do accounting properly. Okay, so these are the three important, guidelines. So, how you can think of GAAP is like the grammar rules of accounting. Okay, just like in English, you follow grammar to write correctly, right? So in accounting, you follow GAAP to record correctly. So what are the major aspects of GAAP? It tells us how to record income, record expense, how to record assets, and it also makes accounting clear and consistent and how it can be trustworthy. Every country has its own GAAP, example US GAAP, Indian GAAP, etc. Okay. So next would be IFRS. So IFRS, so did I actually expand it? GAAP is generally accepted accounting principles. Okay, so IFRS is international financial reporting standards. International financial reporting standards. Okay, just remember this because in one of the exams they've asked you to expand this term, so remember. So INDAS is the Indian Accounting Standards. Okay. So yes, we'll get back to IFRS. So IFRS are global accounting rules made so that the companies in any country can follow the same format. It was made by IASB, that is International Accounting Standard Boards. Okay. So you can think of IFRS like a common language for business all around the world. So an investor in the US can understand a company's accounts in India or Japan or Korea. Okay. So it is used in 140 plus countries and it helps global companies prepare standardized financial reports, promotes transparency, comparability, and consistency. Okay. So this is all about IFRS. So the third thing is INDAS. So when it comes to INDAS, the Indian accounting standards, these are India's own accounting rules that are based on IFRS but made to suit Indian laws and business condition. Okay, it is according to the Indian laws. So Indian accounting standards, we can tell it as IFRS plus an Indian touch to it. Okay, so big companies have to follow the Indian accounting standards when making their financial reports. So what are the key features of Indian accounting? Okay, probably I'll write it here. So it introduced to make Indian accounting match global standards. Okay, so it was mandatory for large companies, and it also helps Indian companies become more globally competitive. So what is GAAP, IFRS, INDAS? So GAAP is generally accepted accounting principles. IFRS is International Financial Reporting Standards. INDAS is Indian Accounting Standards. So GAAP is used by is different for each country. IFRS is for global countries, and INDAS is for Indian countries. For Indian companies, large Indian companies. So GAAP has its own national rules. IFRS has a standard international rule, and INDAS it is based on IFRS. Okay, so right, I hope you understand between all the three different accounting principles. So let's move on to the next topic, right? In case if you have doubt, please leave it in the comment section. I would reply immediately. So, yes. So, what is the difference between credit and debit? I mean, this sounds very easy, right? But this is one of the most trickiest part. People tend to make mistakes in the debit and credit side a lot. So great. So yes, what is a debit? What comes in and what you receive. It is called the debit, right? For credit is what goes out. What goes out or what you give is the credit. Just like if you buy a toy for 100 rupees, the toy comes in, that is debit. The cash goes out, that is credit. So this is also called, you can also compare this with the double entry system, right? Both credit and debit. So, and also there's one three I'm sorry, there is three famous golden rules of accountancy that you should all know. Okay. One I've told you here: debit what comes in and credit what goes out. Second is debit all expenses. Okay. Credit all incomes and gains. Remember this, or you can even by heart it is very important. Debit the receiver, because there are so many MCQs based on this. Debit the receiver, credit the giver. Okay. Yes. So you can also, we'll talk about ledger and T account and everything in the coming slides. Right now, just be sure about what a debit is and what a credit is, and what are the three golden, rules for accountancy. Okay. So, what are the main difference of debit and credit? The debit is passed when an increase in assets or decrease in liabilities and owner's equity occurs, right? Where when it comes to credit, it is passed when there is a decrease in assets or increase in liabilities and owner's equity. It is written on the left side, here it is written on the right side. Here it is a receiver and here it is a giver. Here what comes in, what goes out. The all the other important uh, golden rules you'll have to remember, right? So I hope you understand this. So next would be the basic terms. What is a journal? What is a ledger? What is a journal folio? All that. So we'll start with what is a journal. Okay, tell me what is a journal. The activities that are documented in the fundamental book of original entry. So fundamental book of original entry is called as a journal, right? And then posted to specific accounts in the main book, it is known as the ledger. So this is a very common and general explanation for a journal and a ledger. So we'll see what it does in detail. So journal will be the basic book of original entry. Original entry is the journal. Okay. For example, where the transactions are recorded in the chronological order as and when they take place. But ledger is the principal book of recording. It contains different accounts where the transactions relating to the account are recorded. For example, a ledger may be a collection of all the accounts debited, credited, and journal proper and various special journal. All right. So this is like a final notebook. This is like a final notebook. This is like a original. This is like an original entry, right? So after writing all the transactions in the journal, the first book, right, you group them together account wise and write it them in the ledger. Okay. So probably to explain it more clearly, say you have many piggy banks, one for cash, one for rent, one for sales, one for purchases, all that. Okay. So in the ledger, you write all cash related entries in the cash account, all rent related entries in the rent account, and so on. Okay. So, what is the importance of ledger? It shows the complete details of each account. It helps you know the total you spent or received under each head, right? This is used for preparing trial balance, profit and loss, balance sheet, etc. You get it? Probably if you're still confused, just remember this. Ledger is equal to, it is the book of final accounts. So you group similar transactions together, and also it helps to see the balance of each account. It is also called as the king of all books. King of all books in accounting. So next would be the journal folio. Journal folio is like a small number written in the ledger to show where the original entry is found in the journal. So it also records the page number of the original book of entry wherever the relevant transaction is recorded. Okay, so you can think of it like a page number that helps you trace the transaction back to the journal. Uh, for example, say you write a transaction in the journal, the day book, right? Then you post the transaction to the ledger. When you do that, you write the journal page number in the journal folio column of the ledger. This makes it easier to find the original entry if you ever need to check it later. You get it? Right. So next would be some of the special purpose books. So these are some of the special purpose books. So what is a special purpose book? Yeah, looks like you've already heard these terms, right? Cash book, purchases return book, sales return book. I mean, just like the name suggests, it's quite easy to understand. But yet I'll give you um, the gist of what all it is. So in big businesses, there are too many transactions every day, right? So instead of writing everything in one book, say the journal book, accountants use different books for different types of transaction. These are called special purpose books. So that is books used for recording specific type of transactions. All right. Right. So now, what are the main special books? So cash book, purchases book, or you can tell it as a journal also. You can call it as, okay. Then would be the purchases written book. Then you have the sales book, that is a sales journal. Then you have sales return book, and that is the yeah. Then you have a journal proper. That's not journal proper, or it can also be called as general journal. Okay, so first let's discuss about what is a cash book. So cash book, mm, wait, I need some space for writing, so I'll just tell it all this. So yeah, so what is a cash book? So cash book records all the cash and bank transactions. If you receive or pay money, it goes here. It's like a cash diary for your business. Say for example, you received 5,000 rupees from a customer. Cash in. So 2,000 paid for rent, cash out. So it's treated like a journal and a ledger. So that is called a cash book. It records all cash and bank transactions. So the next would be the purchases journal or the purchase book. It records only credit purchases of goods, not cash purposes or not assets. For example, you buy 100 pencils, okay, on credit from this stationery shop. You record it here. Then you know yes, so you record it here. For example, buying a computer on credit, it is not recorded here because it's an asset. It is not a good, right? So whatever transactions, you record only the credit purchases of the goods. So always remember this. But whereas in cash book, you record all cash and bank transactions. So the next is purchases written book. Here you record goods returned to the suppliers. For example, you return damaged pens worth 200 rupees from a stationery. So this is recorded in the purchases written book. So next would be the sales journal or the sales book. So here you record only the credit sales of goods, of goods. Example, you sold 50 pencils, okay, on credit to XYZ school. So you record it here. You get it? So next would be the sales return book. Here you record the goods returned by customers. So XYZ school returns the 10 damaged pencils that you gave. Okay, so that is written here. So what is a journal proper? This is used to record everything else that doesn't fit in the above books. So journal proper. Then you have something called as journal proper or general journal. Okay, so you record everything. It is also called as old purchase book sometimes. For example, you try to record buying machinery on credit, the depreciation entries, or opening or closing of a stock, the adjustment corrections, all that you do it here. So yes, so a cash book is like where you record all cash and bank transactions. Then you have the purchases book. Here you record credit purchase of goods. Then you have purchases return book. Here you record goods returned to the supplier. Then you have the sales book. You record credit sales of goods. Then you have sales return book. You record goods returned by the customer. Then you have the journal proper. Anything that doesn't go in the above books, you try to record it. So in short, these books help you make accounting faster, easier, organized, and it's quite everything is quite placed and it's very easy to check. Okay. So I hope you understood all the basic terms. In case if you don't understand, please let me know in the comment section. I would definitely reply and explain whatever you didn't understand. So the next would be the types of account. So So what is an account? So account is like the summary of all the transactions particular businesses have made within the respected time regard to a specific person or a business or anything. Okay. So the accounts are divided into three types. Right. In accounting, we generally record transactions using accounts. So every item we deal with, be it money, people, goods, rent, is treated as an account. So all accounts are classified into three main types, that is personal, real, and nominal account. Just like the name suggests, personal. See, if you could, pay very keen attention to all these keywords, you can, you can attend all the MCQs properly and to be very frank, accounting principles is very easy, but people don't actually put in the effort to learn this. So try to learn this. And also the topic is very short. Please don't try to read so much on this particular topic. Just be clear whatever what are the terms, what are the basic concepts, and what are the definitions, and how do you calculate certain say there's some methods with respect to you have certain mathematical calculations in accounting principles. You will get it in the the coming chapters with respect to depreciation, trial balance, all that. So that's it, and you're good to go with accounting. So yes, we'll get back to personal account. So this is related to people, companies, or organizations. If you can say to whom or from whom the money is coming or going, it is personal account. Example, Ram's account or SBI account or Reliance or any other company, right? So you remember the golden rule: debit the receiver and credit the giver. So you give 1,000 rupees to your friend named Raj. So Raj is the receiver and you are the giver of cash, right? So next would be the real. Real is like whatever we can see, touch, or own, all the assets. Okay. For real accounts, the moment you see this, you should remember tangible and intangible. Okay. So here also you have tangible and intangible real accounts. So tangible is like it has a physical existence and can be touched. Example, the building, account, stationery account, etc. Intangible is like it has a value but no physical existence. Like goodwill of the company, the patent, copyright, trademark, all that. So here, so in nominal for real account, you say for example, you'll buy a table for 5,000 in cash. So furniture comes in, it is debit. Cash goes out, it is credit cash. So for nominal account is related to expenses, losses, income, and gain. These accounts are temporary and get closed at the end of the year. So here, for example, it would be the rent account, the salary account, the commission earned account, or in anything related to, say, for example, loss by fire account, all that. So here also you'll have to remember the three golden rules, okay? Here it will be like, for example, you pay 2000 rupees for rent. So rent is like an expense, debit rent. So cash goes out, credit cash. You get it? So personal is for people. Excuse me, I'm sorry. Real is for things, are for things, and for nominal is for money related feelings, expenses or gains, all that. So you get it. I hope you understood today's session. So I'll give you just two MCQs. Try to answer it. What is the underlying accounting concept that suppose no that supports no anticipation of profits but provision for all possible losses? Is it matching, materiality, consistency, or conservatism? It is conservatism. I hope you understood the previous class. We spoke about conservatism, right? What is that? Conservatism is the concept that you should have a conscious approach, right? And you should always expect for the worst. You should look for the loss, right? So here, for the possible losses, it is conservatism. What is consistency? Consistency is like to have the same concept throughout the year, for every year, unless and until you have a very solid reason to change. So what is materiality? Materiality is like you should not waste your time recording and presenting data that will not be used to determine the income like facts, right? So which are immaterial, all that. You should only write which is very important, and that would influence the decision of the informed user for making financial statements. So yes. So what would be the matching concept? Matching concept is like the process of estimating the amount of profit or loss made, during a specific time. So that is called as the matching concept. So for here, the provision of all losses. So the answer would be conservatism. I know it's quite easy. I just wanted to make sure that you remember the previous session. In case if you don't remember, please go to the previous session, and you know understand it better. So second one, which one of the following statement is correct about income and expenditure account? So it is a nominal account. So income and expenditure account comes under the nominal account. Why? Nominal accounts are always related to income or gains, right? And your salary account, your wages account, your conveyance, everything comes under the nominal account. It's a quite easier question, but these two questions came in 2021 paper, and try to revise the PYQs, because it gives you the themes. And also, I would, come up with a video on accounting principles just related to the PYQ themes and topics. So in case if you're new to the channel, please subscribe to the channel, because it's quite a new channel and I've just started it, and I haven't shared it with anybody. I'm just letting YouTube do its algorithm work better. So yeah. I hope you found this session useful. In case if you have any other queries, please let me know.